So another thing that I think a lot of folks actually don't know about, or maybe some misconceptions, or maybe they just don't know at all. They haven't researched this. This isn't what they do in their everyday job. Is just kind of the history of our industry, the finance industry, the financial planning industry, portfolios in general. So why don't we talk a little bit about that, about how it's developed, and maybe some things that have come from it. That would be good if you could shed some light on that.
Yeah, well, so, this analogy is going to dramatically exaggerate the importance of us professionally. But if I compared us to like the medical profession, right, there was a long time where doctors in the 1300s, like what could a doctor do? They might like cut off a limb or something that looked infected, or they didn't know to wash their hands, and there's a long time where the medical profession wasn't particularly research based, science based, things like that, right? And then penicillin came around, and they started developing antibiotics and things, and now there's tons of research behind like antibiotics, and it would take, as an example, a whole lot of research for us to lose confidence in, hey, do antibiotics actually work? If I'm sick or I have an infection in one of my limbs, like antibiotics probably are the way to go, and a lot of self-confidence in that because of years and years of research. Finance was a lot like that up until around the 50s. Is people, stocks were out there, but there wasn't a lot of research into the theories of why stocks had returns and how you could fit them together in a portfolio with bonds and things like that. So really, since around the 1950s, there's been layers of research, academic research into, starting with the building blocks of like, hey, why do some assets return more than others? And from that, we get kind of the basic risk-return relationship in a model called CAPM. We get kind of the beginnings of how to construct a portfolio. The idea is that you can take some less risky assets and some riskier assets, put them together, and you can make an efficient portfolio for somebody's goals. Then the 70s come around, people notice, hey, it seems like some, assets have higher returns than we would expect to based on our conventional measures of risk, which is kind of volatility, how bumpy the ride is. And then you've got papers coming out with, hey, maybe there's different elements of return than just the volatility or the traditional standard of risk. Maybe there's a premium to smaller companies, or there's premium to companies that have a low price relative to the book value of their assets, or more recently, maybe there's a premium to companies that have high profitability, or maybe there's a premium, you can think of it one way, or kind of an anti-premium to companies who grow their balance sheet too quickly. Mm-hmm. So in companies that grow so aggressively, maybe they're doing it inefficiently. And the point I would want to make in it is we use this research to help guide sort of our allocations. We never make 100% bets on certain things, but we'll tilt our portfolios towards and away asset classes we think have better risk return characteristics for our clients. But the point I would make on all that is it's all based on decades and decades of incremental research, where ideas are being kind of flagged and then refined, and it's usually 2 or 3 different academics at different points in time that layer on to contribute to our understanding of just one particular part of the investment universe. And of course, then our job is to take all that complexity, find out which investment vehicles are delivering the types of allocations that we want to achieve those goals, and then the ultimate job to be able to communicate that effectively to somebody, help integrate it into their plan and help stay on the plan long term. And that's we're going to go all the way from the really nerdy investment research part of it, which I love. So I want to ask you a kind of more, I don't want to say more basic question. In a lot of ways, it's a more complicated question because it doesn't have a neat, tidy, spreadsheet type answer. But one challenge to all this stuff we've talked about is on the other side of a portfolio is a human being that is experiencing ups and downs, and as news headlines are coming in, they're probably happy when their portfolio goes up. They're probably upset when it goes down. Sometimes they might be nervous, even if it's gone up, that, oh my gosh, what if it goes down? I guess, can you talk a little bit about, I know I'm probably asking you to like crystallize everything it is to be an advisor into like a 2-sentence response, but like, what advice do you give to clients that, are having, a desire to make emotional decisions in their portfolio, or they let news headlines kind of get to them and they want to change the plan based on headlines or things like that. I mean, do you see that? I guess is one question, and then like what's your advice, or is it always different?
We do see it, we're fortunate to have worked with clients for a lot of our clients for a long time, and that's the favorite part of my job is kind of the coaching aspect of it, because and the mesh between everything you just talked about and that, like, that's really why I love my job, is because I like the technical. I love studying that. I love knowing that. But really what I love is bringing that to people that don't have the time or desire to know all that and to study all that. And it's bringing it to them and communicating it to them in terms they can understand. And I think that's one of the biggest things. To basically what you're asking is, how do you help people control their own emotions? How do you help people stay out of their own way? I think first people have to understand what we're doing at the level that they want to.
Yeah.
And then I think obviously there's trust there and things like that, but they have to understand it so that they can understand that, hey, portfolios go up and down. That's a normal event. We expect the market to go down intra-year somewhere around 15% almost every year. Well, why would you invest in stocks? Well, because by the end of the year, it usually ends in a positive territory. So, but with that is the emotion of it. And so with everything you just discussed, that's all being assumed that people are logical and they act logically. But the thing is, we know that it's scary when times are tough. It's scary when the market's down 50 some odd percent, the stock market's down 50 some odd percent. It was in 2008. There's the COVID example, which is actually a really good example. Yeah. Goes down sharply, comes back sharply. Mm-hmm. So our job is to help people through those times and to get out of their own way. And you mentioned the headlines, to really avoid those headlines. I shouldn't get on my soapbox too much here, but those headlines are created to sell TV space. That is a revenue generator. And so if your goals are aligned with your plan, you should ignore those. Mm-hmm. What does that mean? Well, if my goal is to pull my money out in a week, I should have never been exposed to that stock anyway. Yeah. If my goal is to pull that money out in 30 years, why do I care whatever talking head, I'm not going to name a name. Why do I care what a talking head says on the evening news about this stock or Tesla stock or Apple stock or doing this, that, and the other? I don't care, because that's not my time horizon. That's not my goal. So back to tying this all together. We have all this data. We're not basing our portfolios on star managers, because that's not a reliable thing to do. We're basing it on years of research, academic research that's been refined over many, many years, because that gives us a good base. So if we have a good base, now what we have to do is make sure that we don't shoot ourselves in the foot. Mm-hmm. And that's why advisors can be valuable, to help people manage their emotions, get away emotionally from their investments. We have some people that frankly could do this. They're very smart. They've studied this a lot, but they know that if they can separate themselves from the investments, that will allow them to go focus on what's most important to them instead of focusing on what's going on in their portfolio. They pay us to do that for them.